Most people don't realise this, but what's happening in Iran right now could directly impact UK property prices. Not because of war, but because of what it does to interest rates. And in this video, I'm going to show you why rates could go higher, what that means for house prices, and what smart investors are doing right now. Because this could either hurt you or create a massive opportunity. And most people are completely looking in the wrong place. Let's break this down simply. When there's instability in the Middle East, oil prices tend to rise. And oil is one of the most important inputs in the global economy. It affects transport, manufacturing, heating, electricity. So when oil prices go up, the cost of almost everything increases. And this is where it starts to impact property and actually all asset classes. The chain reaction looks something like this. Oil prices rise, energy costs increase, businesses pass on those costs, inflation goes up. When inflation goes up, central banks step in. In the UK, that means the Bank of England, and their main tool is interest rates. If inflation stays high, rates stay higher for longer, and that's where property starts to feel the impact. And this isn't just theory, by the way, this is already happening right now. Last month, the Bank of England made a decision that a lot of people weren't expecting. They held interest rates when the market was actually expecting cuts. And the reason for that is exactly what we've discussed. Rising oil prices, increasing inflation pressure, and global uncertainty, which is now feeding directly into interest rates. And here's where it gets interesting. Even though the base rate didn't go up, mortgage rates are already rising. Because lenders don't just price off today, they price off what they think is coming. And right now, that outlook is uncertain. You've probably already seen this, mortgage rates being pulled, rates increasing, and deals changing almost daily. And that's being driven by something called swap rates, which is essentially what lenders think interest rates will be in the future. So if we zoom out, there are really three ways this could go. Best case, things calm down, inflation drops, and rates start to fall. Meaning mortgage rates could settle around the 3.5 to 4% most likely. Things stay uncertain and rates hover around the 4 to 5% worst case. If things escalate, oil spikes, inflation rises again, and mortgage rates could push towards the 5 or 6%. Now this doesn't just impact property, it affects all asset classes. So let's look at what typically happens in times of uncertainty. First, the stock market. When there's uncertainty, markets don't like it. You'll often see volatility increase, prices drop in the short term because investors move money out of risk, precious metals. And this is where something interesting happens. Assets like gold tend to perform well in uncertain times because they're seen as a store of value. When inflation rises, people look to protect their wealth. Property sits somewhere in the middle. It's not as volatile as stocks, but it's impacted by interest rates. It doesn't react instantly, but it adjusts over time through affordability and demand. While stock markets move in days, property moves in months and years, which means by the time most people react, the opportunity has already gone. And that's why understanding interest rates is so important, because they influence everything: stocks, property, and even gold. But they affect each one differently. Let's connect this directly to property. When interest rates rise, mortgages become more expensive. Monthly payments increase, buyers can borrow less, and the key is borrowing capacity drives house prices. So if people can borrow less, they can pay less. For example, if someone could previously borrow £400,000 and rates increase, they might now only be able to borrow £320,000. The gap has to come from somewhere, and that's where price pressures come in. But here's what most people don't realise. This doesn't create problems, it creates opportunity. In markets like this, a few things can happen. Buyer demand slows down, properties sit on the market longer, sellers become more flexible, and over time you start to see price reductions and more motivated sellers. Now, this doesn't mean everything crashes overnight. Property markets move slowly, but the direction of travel starts to shift. I actually got a question from someone I'm helping at the moment, and this is exactly what he said. Hi Rav. I'd also like to discuss how the conflict in the Middle East is having a direct impact on UK property market. Since the conflict began, mortgage rates have increased and the Bank of England has paused any potential rate cuts. I'm hearing that repossession rates are expected to rise significantly. Thousands of cheaper mortgage products have been withdrawn by lenders, and even my initial rate quote has gone up from 4.01% to 4.29%. The UK economy was already trying to recover from the effects of Brexit, COVID, and the war in Ukraine. And now this new situation could put the property market under further pressure. I would like to know what would be the impact on the property market and what would be the strategy. Best regards. Mortgage rates are rising, lenders are pulling products, and repossessions might increase. And he asked a really important question. What does this actually mean for the property market? And this is exactly what a lot of people are thinking about right now. So let's break it down. What you're seeing isn't random. It's the system adjusting to higher interest rates. When rates rise, lenders become more cautious, mortgage products get withdrawn, affordability drops, and yes, in some cases, you might start to see an increase in repossessions, which increases supply in the market. And while this sounds negative, this is where opportunities start to appear. And this is where experienced investors think differently, because while most people are waiting for deals to appear, this is when you might see properties below market value, sellers needing to exit quickly, projects that no longer stack for others. Why do people sell below market value? Now, at this point, people often ask, if prices are crashing, where do these deals come from? And the answer is simple. Not everyone sells because they want to. Many people sell because they have to. People sell for reasons like divorce, inheritance, financial pressure, repossession risk, relocation, or sometimes broken chains, properties needing too much work, or needing a quick and certain sale. And when someone needs certainty and speed, prices become secondary. The best deals don't come from the market, they come from people's situations. And in times like this, with higher rates, these situations increase. More pressure, more failed deals, more motivated sellers. At the same time, your average buyer is stepping back, which means less competition and more opportunity. That gap between motivated sellers and hesitant buyers is where deals are created. And this ties directly into what I spoke about in my last video, buying below market value, adding value, and refinancing. Because if you buy well, you can still make money in any market. And if you're watching this and thinking, okay, but how do I actually know if a deal works in this kind of market? Let me give you a very simple framework I use on every deal. Before I move forward on anything, I ask 4 questions. Can I buy below market value? Can I add value? Do the numbers work at the higher interest rates? And do I have a clear exit? If I can tick all 4 of these, I don't need a perfect market. I just need a good deal. The biggest mistake people make in times like this is they become emotional. They wait, they sit on the sidelines. But property has always moved in cycles, and the best investors understand this. They don't chase the market, they position themselves for it. The best deals don't come when everything feels safe. They come when uncertainty is high. It's always been uncertain. And it's important to zoom out for a second, because if you look at the UK, over the last few years, it's been constant uncertainty. 2016, Brexit. 2020, COVID and lockdowns. 2021 to 2022, inflation rising rapidly. September 2022, Liz Truss mini budget. Mortgage rates spiked almost immediately. 2022 to 2024, interest rates rising from near 0 to over 5%. At every single one of these points, people were saying now is not a good time to invest. But if you had waited for everything to feel stable, you'd still be waiting today. Because the reality is there's always something happening. There's always a reason not to invest. The question is whether you can find good opportunities despite that. And what's happening now is no different. It feels uncertain, but uncertainty is where opportunity is created. If you look back at the periods of higher interest rates, that's when some of the best buying opportunities appeared. Not because property stopped working, but because fewer people were willing to act. I'm personally not panicking. I'm not trying to time the market perfectly. I'm focusing on finding good deals, making sure the numbers work, and keeping a margin of safety. Because in markets like this, discipline matters more than ever. Even right now, I'm negotiating on deals where the valuation is coming in lower than the agreed price. And that's creating opportunities. So yes, what's happening globally matters, but not in the way most people think. It's not the war itself, it's the knock-on effects. Most people will sit and wait, investors will adapt, and the difference between the two is where the money is made.